Good morning, everyone. Welcome to the Sensa Edge. This is your host, Zoe Beer. Right, we're going to talk about straddles. Straddles can be an incredible trade or an absolute disaster. If you are flexible, they can make you money, or if you're not, well, they might just break you, literally and financially. In this episode, we are diving into the world of straddles, the risk, reward, and why they might just be a perfect play when the market can't make up its mind. Is this the right time to place a straddle on Citigroup? Let's find this out. All right, in this video, we'll continue on the topic of non-directional trades. Instead of iron condors, we are looking at a drunken cousin, the straddle. A straddle can be a wonderful thing or a painful thing. If you are an inflexible 41-year-old, they are nothing short of painful. If you are a trader looking at an option chain, they are intriguing. Much like our previous video on iron condors, to learn about straddles means understanding that there are trades but no directional bias. Market up is great, market down is great. How much it's up or down is the issue. And just like with the iron condors, the amount of movement the option price in is always wrong. In many ways, our trade for today, the long straddle, is the opposite of iron condor. I'm going to bring up the screen and then let's jump in there. All right, for our new traders or the veterans, you've been so excited about iron condors that you forgot about the straddles. Here's a quick refresher on the straddle strategy. Again, buy a call option, you profit if the stock goes up, as you can see in the screen. Buy a put option, you profit if the stock goes down. The beauty of straddle is you don't care which direction the stock moves. You just want it to move a lot. It's a pure volatility play, perfect for when you expect an outsized move but aren't confident about which direction. As before, a few pre-flight checks to make sure this is a good idea. Let me bring the other screen and then just go over what are those criterias. All right, you're going to look for, is IV usually less than the HV? If so, you have a good candidate for the long straddle. If not, look at iron condor as an alternative. Or the Bollinger bands expanding or contracting. Expanding? Great. Contracting? Again, go back to the iron condor. In this case, there is a third check. That trumps the first two. Is the IV incredibly low relative to its normal? Today, the answer for the Citigroup is a resounding yes. All right, so how do you find this particular candidate? Again, we have already found this candidate, Citigroup, as you can see. We want to scan off all these three criteria as what I just spoke about, the third being the most important. Let's talk numbers for a second. So as you can see on the Citigroup right here, the implied volatility on the Citigroup option is almost at its lowest level in 5 years. The bulk of the S&P is actually down in the 20th percentile, suggesting options are relatively cheap across the board. But Citigroup in particular is in the 5th percentile. That's stupid low. Given the macro environment, the Consumer Production Bureau just got gutted, and there were whispers of the FDIC under the microscope. If FDIC rumors play out, the possibility of the bank's run goes up well past non-zero. A straddle is just the play to take advantage of any of these things. Furthermore, the last time Citigroup IV was this low, we saw a subsequent 12% stock move within the 6 weeks. While past performance isn't any guarantee, it certainly is a clue. If there's one thing traders love, just like us, it's a statistically backed clue. Straddles on Citigroup are relatively cheap right now because of this low IV. You are essentially buying tickets to a high volatility show at a bargain bin prices. Even a modest spike in the IV, let alone a directional move, could lead to a very favorable risk-reward scenario. With the Citigroup currently trading around $81.11, as you can see, here's how we can set up the straddle. So I'm going to bring up the other strategy screen on the Sensa market. You can go to Sensa market option strategies. I've already picked up the long straddle, as you can see, Citigroup at $81.11. So you are buying a call position and you are also buying a put position at the same expiration date at the same price. So $81.11 the stock price, I'm buying 80 call and also buying a 80 put. I'm shooting for somewhere around 93 days out, May 16, which is a reasonable kind of an expiration date. The total cost of this straddle will depend on the current option premium, but at this point of time, debit of $8.90 per contract. This means your break even at expiration is plus or minus $9. As you can see on the break even right here, which is $71. If it goes anywhere less than 71, you're going to make profit. Anywhere out of or more than $88.90, you're going to be making profit. Again, step number 2, once you set up this thing, the plan, this is not like set the strategy and just forget about it. You're looking for one of the two things: a sharp directional move in the stock, a rise in the implied volatility, allowing you to sell the straddle for a profit even if the stock hasn't moved much. Your maximum loss is limited to the premium you paid, in this case $8.90, but you need a plan. Cut and take a loss. The option price hits anywhere, whatever your loss is. The maximum loss is at $890, which is per contract. It's a trader's choice. Take profit of the Citi. Take, like, you can choose your own, like what could be like the maximum thing you'd like to shoot for, or what will be the minimum to take in the profit there. Again, it's completely trader's choice. You can set those stop levels or how much you want to take profit from. If you ask me, I'd shoot for half the option spread price or a double. Again, quick note for more advanced traders here, you could also scalp gamma until IV reverts to a normal level and take profits that way. Beginner traders could go do a bit of research on this gamma scalping for homework. As a reminder, how much there is still to learn. It never stops. Again, what could go wrong? Every trade has risk, and straddles are no exceptions. The big ones, time decay, no movement, are the big ones, and then also the overpaying for the premiums. Again, if it is a time decay, options are wasting assets and the clock is always ticking. If the stock stays flat for too long, your straddle will lose value due to time decay. If there is no movement, if the Citigroup doesn't budge or IV stays low, you'll take a loss from the time decay. If you're overpaying for the premiums while IV is low, that doesn't necessarily mean that they are underpriced. If Citibank goes all of nowhere, you'll still lose. The key to managing this risk is to keep your position size small, monitor the trade closely, and have an exit plan. All right, let me bring back myself here. Final thoughts on this. Hope this straddle thing was good. Again, like straddles can hurt. Again, if I have thrown a groin or pulled a groin, broken a groin, whatever the proper word is for the straddle before, had I gone in knowing the risk, I wouldn't have jumped on the trampoline in socks. In your case, know what your risks are going in and make sure to have a plan. Citigroup options are dirt cheap and macro, black swan risk is crazy high. It makes for a compelling trade, but not a riskless one. Trade safely, allocate responsibly, and for God's sake, don't wear socks on a trampoline. Join us daily for market insights, trade ideas, and actionable intel on all things volatile in the market. Be sure to subscribe, leave a review, and follow us on the platform. Happy trading.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.